What's up, you guys? One of the biggest reasons I see route contractors fail or even file bankruptcy has to do with not fully understanding the working capital requirements that are unique and specific to routes themselves. Now, this happens because a lot of sellers don't want those buyers to understand the framework and the ways that you would go about thinking about working capital correctly, because if you did understand that, what happens is it scares off a lot of buyers because it unveils a lot of hidden complexity that is unique to the route model that people didn't expect. Now, when buyers get themselves into trouble, it's not that they didn't think about working capital requirements. They did. They just used the wrong sorts of methods, conventional ways to establish working capital that works in other business models, but not so much in the world of routes. And in this video, I'm going to show you the framework that I would use to start to think very clearly about all the elements of working capital so you can be able to figure out what it should be for your particular situation. Now, I've worked with successful contractors for over a decade now, and I've seen the way they think about their working requirements for large organizations, and I've distilled those methods down into a framework that you're going to be able to use to mitigate your risk massively. So people that I've worked with in the past during an evaluation will often ask how much I think they need for working capital. But instead of just answering this directly, we've got to get to the underlying cause of this question and what they're really trying to get something valuable. Now, working capital in the traditional sense, a lot of times people will see like, let's say a deck building business. Well, you got to get the money for the labor, you got to get the money for the materials. It takes 3 weeks to build it, and then you get paid. So you need money, working capital, between the time that you're putting that job on and you're finishing that job and getting paid. In the FedEx or even bread route world, you're getting paid essentially only a week later. So the only money that you need, working capital that you need, is essentially the money that's needed for that 1 week of operations, which typically for routes is gas, some sort of an idea of your maintenance, and your payroll. Now, there's other expenses, but we're talking about the main ones here. We're not going to go into every little thing like the insurance and the uniforms and the ground cloud subscription and so on and so on. Now, the way most people think about evaluating businesses is trying to figure out if the seller is truly making what he is claiming. So if he claims $300,000 and he's really netting $300,000, well, all systems go, let's buy it. That doesn't work because it makes you ignore the working capital requirements. And some of the routes out there practically have no working capital requirements at all. Some of them require basically all of your profits to go towards working capital, which is why they're for sale. Now, this happens due to the counterintuitive way that routes pay for their contractors and a lot of odd variables that are basically impossible to know about unless you were already in this industry. Now, I know that sounds crazy, but just bear with me for a minute, and that way you don't get taken advantage of by any of these sellers. So how do most people go about figuring out working capital requirements? What they do is they take a percentage of gross revenue and they use that. And they think that figuring out the answer is just figuring out the right percentage of gross for that working capital estimation. That doesn't work, and I'm going to explain very clearly why that doesn't work. So now that we know that that doesn't work, I'm going to show you what does work in this framework. So when people are asking this question about working capital, I'm going to define working capital as the expenses you didn't expect, or the amount of money that you may need to have beyond that purchase price. Now, I know that this is not the technical definition of working capital, but this is a much more effective way to think about it in terms of what most people are asking me when they ask how much working capital is required for these businesses. And whenever they're saying, well, how much money extra do I need to have in the bank sitting around? Well, let's say you have access to a bunch of capital via loans or credit cards or whatever. Then you could say, well, you don't need to have anything in the bank. But that's not really what they're asking either. They're asking how much money needs to be available, whether it's via a loan or whether it's just sitting in the bank. That's what they're trying to get at, and that's what we're going to address here today. So with that question, there are 3 specific periods that we have to consider to start to figure out an answer to that. The first period is the acquisition period. So this is right after you've taken over or during the process of taking over the routes. Maybe you are setting up your corporation. You're paying for a lawyer to get your articles of incorporation drafted. You are paying for your CPA to help you do your 941 quarterly deposits for that initial time. You are paying the sales tax, transfer tax for the vehicles, potentially in differing states. Now, it's going to vary dramatically from one person to the next because maybe you've already set up a bunch of companies before. You know how to do all those things yourself. You're not going to have to pay for lawyers or CPAs. You want to do it all yourself. So now your expenses are zero. Maybe you're in a state that has no sales tax for vehicles. So there's zero as well. So it depends on you for how much working capital is going to be needed for your acquisition period. Now, the second period is your operational period. Now, this is one of the more complex periods that we have to discuss. I'm going to come back to this and talk about this more in just a moment. But right now, the third period is your contract renewal period. Now, this is one of the biggest points of risk that you have in these types of businesses. So let me tell you a story real quick. I was working with a girl about 10 years ago, and she was trying to do the evaluation on her own. She was chatting with the guy. All the financials were looking good. And she said that she goes to meet up with this guy. He doesn't want to meet up at the terminal for whatever reason. They meet up at a coffee shop. And she sees this dude like get out of his car. And this car looks like hell. She's telling me like it's all dinged up. It's missing a hubcap. Looks like it's 15 years old. The paint's all peeling off of this thing or whatever. And she says that they're having like this chat and everything seems good. Like the finances like all seem legit, like with what he's saying, what he's claiming. And she says it just keeps eating at her like, God, you know, you're claiming that you're making like $200,000 a year, but your car looks like a piece of crap. Like, so she says she can't hold it in anymore. She says, hey, is this like a work car or something that you've driven out here in? And you have like a different like primary car that's nicer or whatever. And he says, no, this is my primary car. I just want to have a lot of cash available. So in case I might need it on a moment's notice for this business. And she realizes right then, she doesn't know what she doesn't know. And she says, oh, I better reach out, which is why she reached out to me to start to understand this business better. And as we were going through the evaluation process, I'm looking through the settlements and looking through some of the P&Ls and everything. And I go, you know, just for fun, why is this guy selling? You know, what's the reason? She says, oh, he's, you know, it's not really up his alley. He wants to do something in a different industry. That's all. And I'm like, no. First off, that's not a real reason why you'd want to sell. There are other sorts of underlying reasons that would cause that. But the real reason why he wants to sell is his contract's up for renewal. Now, in this case, this was back about 10 years ago or so. And this route was delivering somewhere around 350 stops or so in a day. Well, I happen to know that the contracts that were coming up were going to require a 500 stop minimum in that particular state. And so he's not going to get his contract renewed. Now, she's thinking that she's already figured this out because she's looked at his service levels and he's not doing poorly. So why would he get terminated? You know, hey, FedEx would just keep renewing it. That's true, but not always true. And so this guy wants to sell because he realizes his contract's not going to get renewed. Now, he can probably tell himself that he's not like a terrible person or scamming her or something like that because he's going to say, well, you know, maybe she'll be able to buy the additional routes to be able to get up to 500 stops. Maybe this is a good opportunity for her to grow. You know, maybe this is going to be just fine for her. And hey, maybe the contract doesn't end up requiring 500 stops. And maybe I'm just overly paranoid and I shouldn't have even sold. I'm still a good guy. So it's not that the guy is like trying to scam her or try to lie and watch her, you know, basically go bankrupt or something like that. That's probably not what's happening. But the reality is that this is probably his real reason for selling. Now, maybe he realized that he couldn't buy the other routes from other contractors, and maybe he's thinking that she can pay a higher price, so those guys will sell, so you can have the 500 stops to get your contract renewed. So the contract renewal period is really, really critical, and it's very, very difficult to guess a lot of times, because what could happen next? Maybe FedEx requires 10 route minimum. Maybe they require you to have a 50 route minimum. Well, are you keeping piles and piles and piles of cash in your bank account to be able to buy out all these other contractors? Well, this guy who's paranoid probably was trying to do that and trying to be able to have enough working capital to pivot and adapt to whatever these contract stipulations would require. Now, on the other side of that, in terms of like people being fearful whenever they see these contracts, you can also be greedy in these contracts because you can also look at it and say, hey, wait a minute. Everyone else is going to be selling. All these small contractors are going to be bailing. They're going to be paranoid. I'm going to be able to buy up a bunch of routes for cheap. I might even get routes for free if these guys won't sell to me. All sorts of opportunity are going to come at this as well. So sometimes people see these things as a big opportunity, and maybe it is, and sometimes people see it as a huge risk, and sometimes it is. It depends on where you are a lot of times with what your aspirations are and your working capital. So only you are going to be able to determine how paranoid or how greedy you might be in these sorts of situations in terms of how much money you want to have in that bank account. Now, remember, most of the time whenever we see these sorts of massive changes, there are notices given years, heads up. A lot of times it does not affect all contractors, and a lot of times it's not even all that bad. And again, sometimes it's an opportunity, sometimes it's not. But again, there are exceptions to that too. Look at the contractors in Canada, for example. So it's something that we need to think about, and a lot of sellers don't want you to think about it because it will make a lot of buyers freak out, period. So now that we've dealt with the initial acquisition period and the contract renewal period, let's go back to the operational period. So to start, there's only 4 different things that will primarily affect the operational period in terms of how much working capital you need. So first one is growth. There are only 2 typical forms of growth. One is that more people are shipping with FedEx in your territory, more people are moving in, those sorts of things that are territory specific. And then secondly, your growth of peak season. So in the winter months when people are shipping out for holidays, yes, that is going to affect things, and it's going to feel the same, although you really want to handle both of those types of growth slightly differently. And growth is an extremely complex topic in terms of routes. It's going to have to be for another video, for another day. But right now, just know that growth is going to be one of the 4 primary characteristics of the operational period. So with growth out of the way, there's really only 3 other things that are going to affect this period. The next thing is you. The next thing after that is going to be your territory, and finally, your fleet. Now, I know that the idea that you are going to affect your working capital requirements as opposed to the business itself sounds weird. I'll come back to that, and it'll make sense, I promise. But let me talk about the fleet and the territory first. We'll come back. So let's talk about the fleet. Now, in regards to the fleet, you're really only going to have 2 things that affect that. One is the amount of accidents that you have, and 2, the amount of maintenance that you have on that particular fleet. Now remember, you can't control accidents. Doesn't matter if your truck is brand new or if it's 15 years old, you can get into an accident pretty much the same amount of probability. Now, in terms of the random breakdowns, yes, the fleet's going to matter. Is it 2 years old? Is it 15 years old? And a lot of times people think that if they just buy a brand new vehicle, it'll never break down. They don't have to worry about that. They don't have to have any working capital for that. It's all fine. It's not. These trucks will break down in the stupidest, most ridiculous, unpredictable ways that you could imagine or couldn't imagine. And so the point is you can't really get away from these breakdowns. But hopefully you're seeing that just on this one aspect alone, that anyone that tells you, oh, just take 10% of the gross and that's your working capital requirement. Like, what are you talking about? Is the fleet 15 years old? Is it 2 years old? It's going to be like so different based on this one aspect alone in terms of how much money you need to have extra in reserve in that bank to be able to handle the random breakdowns or whatever. And so anyway, just on that one aspect alone, you could start to see that this whole idea of percentage of gross is going to break down. Anyway, so the third thing is your territory. Now, in downtown Tampa, Florida, where there's no snow, lots of roads are paved, there's no mountains, that's a lot easier to manage than a route in West Virginia. Maybe the miles are further. There's dirt roads everywhere. There's mountains. There's snow. There's all sorts of things that are going to cost you money in terms of both accidents and your maintenance in terms of breakdowns and whatnot. So it's going to be vastly different based on just your territory alone. And so it's important to remember that whenever you start to stack up your territory's differences and all the accidents and things like that that can happen in one territory versus another, then you start to stack on your fleet age and things like that. Now you're starting to get wildly different figures. The percentage of gross completely breaks down on 2 aspects. So the final thing is you. And the reason why it's you is because you are going to have your own style of fleet management. Are you going to deal with these repairs by not repairing the truck and just replacing it altogether? Are you going to get the cheapest part possible? Are you going to get the cheapest tire whenever it pops? or you're going to get that 60,000 mile tire because it's going to go in all seasons or whatever. So how you're dealing with all the problems that are happening from the fleet, the territory, the age, all these sorts of things are going to be affected by how you are operating things. And people operate their fleets and how they're dealing with those expenses very, very differently from one to the next. So between the fleet, the territory, you, and your growth rates, you can see why using a percentage of gross is like completely ineffective, because each one of those aspects that I just laid out is going to be massively important in terms of trying to figure out what that working capital is. So in terms of thinking about your working capital, you really just need to take it into this framework, and then you can figure out the answers to each individual element and solve for each of those individual units. So you're solving for the 3 periods, which is your acquisition period, your operational period, and your contract renewal period. And then in the operational period, you are solving for the growth, the fleet, the territory, and then yourself. And then also considering the 2 types of growth, which is going to be peak season and then your territory growth. Once you have that, then you can start to go in and individually, for your situation and for you specifically, try to figure out what the actual numbers are going to be, as opposed to using blanket generic formulas that don't actually help you. So in terms of starting to get an idea about how much dollar amounts that you're going to be spending on your trucks, check out this video here where I talk a bit more about dealing with replacing trucks and trying to get a feel for your own personal art of fleet management. So like, subscribe, and we'll talk to you soon. Bye-bye.